Okay, so very good morning to you. Um, this is a new topic which we shall carry on. We begin today, and the main, if I can say, the nickname of this topic is homemade leverage, which basically is addressing a very important question, and that is, can individual investors hedge themselves due to the change in the firm's capital structure? Now, to understand this topic, you need to understand that we talk a lot about the capital structure of the company. That, hey, this is the financing side. The company's finances, they come from debt and equity, and then we calculate this ratio of debt and equity. And remember that last week we have a lot of discussion about this debt tax shield, how to calculate it. We also need to understand that this question between debt and equity is not just restricted to the company. It is also concerning the investors of the company, especially the individual investors. Like, for example, let's say I want to invest in Finnair. Finnair would be debating a lot of things about debt and equity, and they can change their debt and equity. And imagine that I'm a Finnair investor. Now, when I invest my wealth in Finnair, I also have to discuss about my debt and equity. Maybe I'm investing 100 euros in Finnair, and 40 euro which I invest in Finnair have been a borrowed money. So I took some loan. I borrowed from the bank, and then I invest in Finnair, and 60 euros are from my own pocket, my own savings. I can call it my equity. So if the Finnair, where I invest in, their debt to equity ratio is 0.75, which means for every 1 euro of equity, Finnair has a debt of 75 cents. On the other hand, if I invest 100 euros in Finnair, and 40 is debt and 60 is equity, so my ratio will be 40 divided by 60. So basically 2/3 or 0.67. So I have my own debt to equity ratio. So when there's a change in the Finnair's debt to equity ratio, this will propel me, or this will actually compel me to change my debt to equity ratio as well. So whenever there is a change in the financing ratio of the companies you invest in, the investors cannot remain unaffected. They also bear the impact. The impact is basically taxation. We discussed last week that taxation makes one form of funding, financing, more attractive than the other, and likewise. So same way, if the company is making a change in its financing mix, debt and equity, the investors cannot remain unaffected. They can be better off, they can be worse off. So it's a sort of risk management that when a firm changes its financing, there's a risk that investor would be affected unfavorably, negatively, or investors capable enough to hedge themselves against any potential change in the capital structure of the firm. And if the investors are able to make this strategy to hedge themselves against any financing change by the firms they invest in, then we are essentially talking about the homemade leverage. The homemade leverage, look at the word homemade. So it's a very kind of very at the individual level, it's a very household level, it's a very basic small investors level. Okay. So that's what we're going to discuss today. And I think it's a good idea that we take an example before we start. The first example is about the movement away from debt to equity. Imagine the interest rate on debt is 5%, which means that if I want to borrow money from the bank, I need to pay a 5% rate of interest. But if I deposit money, if I lend my money to the company, so the company borrow from me, they also pay me 5%. So let's say this interest rate is same. The EBIT, the earning before interest and tax for each firm or each situation is 50,000. Deliberately, I keep the EBIT constant because I want to prove that the operating profit of the company in any situation is same. But basically, when it comes to the financing decisions, the one form of funding could be better than others. So the EBIT for each firm is 50,000 at the end of year. Yeah, we're not taking into account taxes because that can make our calculations complicated. But of course, we can take taxes into consideration as well. But in this example, for the sake of simplicity, for the sake of clarity, I'm ignoring taxes. And the dividend payout ratio is 100%. It means that all the profit which the company is earning, they are shared to the investors, the shareholders. The topic is that the title is that the movement away from debt to equity. The movement away from debt to equity, which means that the company is giving up its debt. So the company used to be L, firm L here. So you could see that the company's value was 200,000, 100,000 coming from equity, and $100,000 coming from debt. So when you calculate debt to equity ratio, it was 1. 100,000 divided by 100,000. 1. The company wants to get rid of all the debt and replace it with equity. So you can see here that they want that this should be eliminated. And to fill the gap, the company should raise another 100,000 equity, so that the total equity is the previous equity, the old equity, plus the same amount of new equity. So the company's value is 200,000. And in other words, your debt to equity ratio becomes 0 because there's 0 debt. So 0 divided by something is 0. So that's the whole idea. So the company wants to go away from 1 to 0 debt to equity ratio. That's the idea. Maybe the company, why would company think like this, by the way? Why do you think that the company wants to go away from debt to equity? So here the idea is that the company used to have debt, but now they're planning to go away from debt altogether and only get financed by the equity. My question to you is, why would a firm take such decision? Yeah, so there can be several reasons why you move away from debt to equity. The first factor which comes to my mind, why would company not have debt and instead have more equity, is that if the interest rates are expected to increase in the near future, if there is a strong reason to believe that the interest rates will go up, it means you have to pay more on debt. If tax rates are expected to go down, then the debt tax shield will not be so attractive. Remember that last week we had discussion. I can quickly show you that the debt tax shield was basically the corporate tax rate multiplied by debt. Okay, so the debt tax shield for a given amount of debt would be in proportion, in a direct proportion to TC, the corporate tax rate. So if in a country the tax rate is very high, then the debt tax shield, the advantage which you get through debt financing will be very high. But if in a country the debt tax shield is going down, the tax rate is going down, then the debt tax shield will also be less. So if this tax rate is not 34%, but 14%, then this Similarly, if you have the higher rate of, can you hear me? Am I audible?
Yes.
Okay, good. So similarly, if the rate of interest is high, but the corporate tax rate is low, then not only you have to pay more amount of money to your lenders, but at the same time, you get very less advantage through the debt tax shield. So therefore, the firms may choose to retire debt with equity. That's one reason. And the second reason is that servicing. Debt servicing means when you borrow some 100,000 euros, you have to pay a part of your debt every year back to the uh, to the lenders, and you also have to pay interest on it. There's nothing you can avoid. You can't basically postpone it. So it's something and a compulsory cash outflow. Whereas there is no such compulsory cash outflow if you have equity. Look at the situation on debt. You have to pay back debt, and you also have to pay the interest rate. In equity, you don't have to pay dividend. I mean, of course, companies give dividends, but the companies may choose not to give any dividend. And the companies may not choose, may even choose not to return your equity amount. So the situation, if you look in a very theoretical perspective, it looks that there is less payment pressure on equity. The payment burden, the pressure, the you feel as a CFO is less in case of equity financing than the debt financing. So for debt financing, you must generate certain amount of cash flow so that you can pay back your debt obligations, whereas such obligations are fewer in case of equity. And third reason is that the debt increases the potential bankruptcy of the company. There's always a chance that you will not meet your deadlines of paying back. Maybe if you have 1 or 2 or 3 bad years of the company's performance, the equity investor, they can be more patient or they can leave the company, but they will not force the company to give them any dividend actually. But you cannot have this situation for debt holders. You must pay them back. So that's why the companies can go away from debt to equity. Okay, we are back in our example. So the company borrows, it pays 5% rate of interest. Whether you are a levered company or unlevered company, or whether you are the same company, first levered, then unlevered, the EBIT, the operating profit remains same, 50,000. We don't consider the taxes, and the 100%, the profits are shared in the form of dividends. Let's say what happens, how much money you get, and let's assume that you have invested $10,000 in the company, and that is a situation when the company was levered company. So this is firm L. So remember, this is the balance sheet of firm L. This one, 100,000 debt, 100,000 equity. When you invest 10,000 in firm's equity, 10,000 is the total equity is 100,000, and you invest 10,000. It means you are 10% owner of the company's equity. This 10,000 is 10% of 100,000. The firm is having its operating profit, $50,000. And let's assume that this company has, well, we don't have to assume actually, the company has debt of 100,000 and the rate of interest is 5%. So 50,000 is your total profit, the EBIT, the operating profit, and then you pay 5% rate of interest on 100,000. Remember, 100,000 is the debt of the company, and 5% is the rate of interest. So after paying the interest to the debt holders, company is left with 45,000. And this 45,000 is available for the shareholders, the equity shareholders. And we have this assumption here that 100% of your profits, or it's not revenue, it's profit, that 100% of the profit is distributed among the equity investors. So it means that all this 45,000 would be shared among the shareholders. And since you are owning 10%, therefore you will get 10% of the profit as well. So 10% of the profit, 10% of the remaining profit. The total profit was 50,000, but 5,000 goes to the debt holders. So you're left with 45,000, and 10% of 45,000 is 4,500. It means this is what you get from the company at the end of the year. So you invest 10,000 in the firm L, and after 1 year, you get 4,500. So when you calculate it, return on investment, it's 45%. You get 45% rate of return on your equity investment. So remember this 45%, that you are an investor and who has borrowed, who has invested in 10% of the firm's equity, and at the end of the year, you are earning 45%. Remember, this figure is very important to remember. Now what happens? The firm where you invest in, it decides to become no longer L, but decides to become U, which means that this debt would be replaced by another dose of 100,000 equity, so that it's all equity. Dollar to dollar replacement of debt with equity. And now what happens? You still have 10,000, amount in the firm equity, but remember that now you don't own 10% of the company, you own 5%. You invest 10,000 in the company's equity, and now company's equity is not 100,000. The company's equity is 200,000, and 10,000 of 200,000 is not 10%, but 5%. So it means that when the company replaces debt with equity, more equity, and you are owning a certain amount of equity of the company, then your relative share of ownership goes down. So what happens now? You get, sorry, just a second. Yeah. So can you do this calculation for me? The company's operating profit is 50,000. The company pays no debt. So company, now just consider that this is not L, but U. The company's operating profit is 50,000. There is no debt, so there is no payment of 5,000 to debt holders. So all the money, 50,000, is available to the shareholders, and you are 10% owner, 5% owner of the equity, and 5% of 50,000 is 2,500. So this time you get 2,500, and 2,500 means you invest 10,000 and you earn 2,500. It means the return on investment is 25%. It used to be 45% when the company was levered, but now the company is unlevered. You get only, 25%. I can do this calculation very quickly for you. So in this situation, the company's operating profit is still 50,000. And now the company's total value is, the company's total equity is 200,000. 1, 2, 3. Yeah. So this is the total equity. And there's no debt. There is zero debt. Debt is zero. And the investor has invested 10,000. 1, 2, 3. And 1,000, sorry, 10,000 is basically 5% of the firm value. All right. And now there is no debt, so there is no interest, so you get 5% share of the company's EBIT, which is 50,000. 5% of 50,000 is, if I'm not wrong, 2,500. So you invest 10,000 in the company, 1, 2, 3, 4, and you get 2,500, and hence your return on investment is 25%. If you remember, it used to be 45% when I showed you the slide. It used to be 45% then. It means that movement away from debt to equity is unfavorably affecting the equity investors. So in other words, when the company is making a decision to replace debt with equity, the existing equity holders are unfavorably affected. If you remember, and I can show you when I go to the slide, that this amount was not 2,500 that you will get from the company. It used to be 4,500. But now this is 2,500. It means that you have lost a lot of money as an equity investor. The question is that, what can you do now? What can you do now that you still get 45%? For this, we need to go to the slide back. What can you do? Well, what can you do is that you borrow additional 10,000 from the bank. So your own personal household equity used to be 10,000, and you were not borrowing before, so your debt to equity ratio used to be 0. But now the company has moved away from its debt to equity ratio 1 to 0, but you can still keep it 1. What you can do is that you can borrow individually. So you go to the bank as an individual person and you borrow 10,000 from the bank. And remember, 10,000 additional, another 10,000 was your own equity, your own savings. So 10,000 is in your pocket, which is in this example anyways, because you invested 10,000, you'll borrow 10,000 additional from the bank, and you invest 20,000 in the company now. When you invest 20,000 in a company whose equity is also 200,000, then you get 10% ownership. Remember, I showed you that your ownership shrink from 10% to 5%. But now you have your 10,000 own money, and you also borrow 10,000 additional money from the bank. So 10 plus 10 makes it 20, and 20,000 of 200,000 is 10%. It means you are able to regain 10% equity. And the company doesn't borrow, it doesn't pay any debt, any interest. It means that you have a claim on 10% of company's profits. And then 10% of 50,000 is 5,000. So you get 5,000. Okay. But don't forget that you have borrowed 10,000 in your personal capacity, and the interest rate is 5%. The company is giving you 5,000 dividend, the share of profits, but actually you need to pay out of this 5,000, you need to pay 5% rate of interest on your borrowing, which is 500. So 5,000 minus 500 is 4,500. And here I write, have you seen this money before? Yes, you have seen. This is the same amount of money which you would get when the company was levered. So now you are getting 4,500, same amount of money when the company has become unlevered, which means that you are able to maintain your cash inflows as you used to get. So your rate of return on this entire investment is again 45%. In other words, when a company make a change in its financing and it affects you unfavorably, then you can make changes, compensating corresponding changes in your personal financing, that your rate of return on investment is same. This is the main idea of homemade leverage. That if company stops borrowing, you can borrow in your personal capacity. And the borrowed money you can invest in the equity, so that on the one hand, your share of equity is same as it used to be before, but you also maintain your personal debt to equity ratio. See the situation. The company's D to E ratio was 1, but that time your personal D to E ratio was 0, because all the 10,000 money you invested was coming from your own pocket. Now the company's D to E ratio is 0, but what you did, you created your own personal homemade D to E ratio equal to 1 by borrowing additional $10,000 from the bank in your personal capacity, so that you invest 20,000 in the company equity, but out of this 20,000 you invest in the company, 10,000 is your own money. You can call it your own personal equity, but 10,000 you get from the borrowed money from the bank, and you are able to maintain the same debt to equity ratio 1 in your personal rights. This is the idea of homemade leverage. Questions, comments? Same thing you can do when the company move away from equity to debt. So the same thing. This I didn't write in with any proper example, but just I created some symbolic, so we can skip it. But of course, you can change your, you can change when the company is moving away from equity to debt. You can also consider that if you get the same amount of cash flows or not. The next subtopic which I want to talk about is debt capacity. The debt capacity is that different firms have different debt capacity. The debt capacity is the amount or the proportion of debt in the total value of the company which it is capable of borrowing. There's always a capacity of the company to borrow. The company cannot borrow endless amount of money. There is a certain limit to the borrowing which you can have. But this limit or this proportion is not same for every company. This difference vary from industry to industry, sector to sector, or even firm to firm. So no two companies are capable of having the same amount of borrowing because their debt capacity to absorb debt in their financing is different, is not same. And that essentially is called debt capacity. So when you talk about debt capacity, you need to consider a few things. The first thing you need to consider is that what are the advantages of debt? Well, the first advantage of debt to me, it seems that debt is cheaper than equity. We discussed many times now in the class that you don't pay tax on the the interest, the finance cost you pay, the debt cost you pay is exempted from the corporate tax rate. So this is an advantage. One. The second advantage of debt seems to mean that the debt makes the managers, the executives more accountable. Their level of responsibility goes up. They become more disciplined. On the other hand, the negative side of debt is that there is a permanent pressure on the cash flows. You have to pay back this amount of money. And secondly, when you are borrowing too much, then you are inviting financial distress cost. The financial distress cost basically is the probability of bankruptcy. So when you borrow, when your borrowing increases, the chances that a company can become bankrupt goes quite substantially up. Because when you are not able to meet your outsiders' obligations, you're not able to pay back the interest and the installment of when you're not able to repay the debt, then it's possible that the bankruptcy proceedings can be started against you, your company. So there is the negative side and the positive side of the company. But apart from that, there are some other factors also which can make your debt capacity up and down. If you are a company who has more tangible assets, I can actually write down so that you know what factors make you a better borrower and not so good borrower. So the first factor which comes to my mind about the debt capacity is, so we can write down factors affecting debt capacity. Apart from the factors that we discussed in the debt tax shield example, I can say that the company which has more tangible assets. Tangible assets can be used for the mortgage when you borrow. But if a company has less tangible assets, then the company doesn't have much to mortgage. So I want to ask you a question now, that if you see Microsoft and British Petroleum, who is a better borrower based on this tangible assets? Who do you think is a better borrower? If Microsoft and BP go to a bank and they say that we want to borrow, who do you think manager would be more keen to give lendings based on this principle of tangible assets? BP, yes. Why so? Because BP has more tangible assets, whereas Microsoft has mostly its assets are intangible assets in the form of those softwares and those formulas and ideas. So firms with more tangible assets are capable of borrowing more in comparison to the companies with more of intangible assets. Okay. The next factor comes to my mind is history, legacy of the company. Or in other words, we can call it the age of the company. I mean, the old companies versus new companies. And what do you think about? Are young firms able to borrow more, or the old companies able to borrow more? If you have a startup, it goes to the bank, and at the same time, there is one established company goes to the bank. Who bank manager would prefer in terms of giving debt?
Yeah, with a longer history.
Mm-hmm. Any reason for it? Any reason for this discrimination?
They have longer and more experience, so they can show how they operated the last years better.
Yeah. So if there is a company which has a history, it itself is a proof that company has seen many bad times. I mean, if a company is 100-year old, it means that during this 100 years, there must be many ups and downs, and the company is able to withstand those shocks. So there is an evidence that in the tough times, the company is still able to survive. Whereas there is no such historic evidence for a new company, or very less evidence, and not even startup, but some company which is young, 10 years, 12 years. So maybe there is no evidence to prove that the company is capable of going tough through these tough times. Whereas for the old company, there is a evidence, historic evidence. So the company would prefer the firm with much longer history. Another factor which comes to my mind, which determines the debt capacity, is the stable cash flows, stable and sizable cash flows, cash inflows. What do you think about it? If you are Prisma versus some, let me find some casino. How do you distinguish between the debt capacity of Prisma, the retail store, or like Lidl or any other grocery store, in comparison to a casino? Based on this third point, who should be having higher debt capacity and why? I'm not sure about the size of the cash flows, but in terms of stability, Prisma cash inflow should be more stable than casino. But the casinos, it can go up and down quite a lot. It can fluctuate. People do a lot of gambling, the revenue of casino goes up. People don't do gambling because they don't have money to gamble. These times, the cash flow can go down. On the contrary, Prisma normally sell the essential goods, the food, shelter, I mean, the food, clothing stuff. People buy them. Even in the bad times, they buy them. And not only they buy them, they continue to buy the food for the kitchen, but also they grocery for the kitchen, but they also give them cash. So it's a very cash-based uh, industry, the sector. So those uh, professions, those industry where the cash flow is stable, consistent, and sizable, the banker, the lender would be very pleased to give them debt. But those which have very inconsistent, fluctuating cash flow, and the size of the cash flow is also questionable, because sometimes the cash can be very high. Sometimes when it's good time, but in the bad time, the cash size can go down. Then in such situation, the bank is not able to forecast that whether the company can pay back or not. In fact, the stability, even if the two companies having the same size of cash flows, but one is stable and the other is unstable, the bank would definitely choose the one with stable cash flows, because they want to make sure that what they get after every interval should be the consistent amount. Okay, the next thing comes to my mind is the operational cost. A firm with lower operational cost are able to have more debt capacity, and the firm with the higher operational cost are having higher, the firms with the higher operational cost are having lower debt capacity. And if I want to give the example of many of you are living in COAS, do I understand it correctly? These student apartments.
Yes.
And let's compare it with the let's compare it with some IT company, or maybe some factory, textile company which makes clothes. Who has a lower operational cost? Imagine there is a one housing company, and I gave the example of Quas, and the other is some textile company making clothes. Who you think is having higher and lower operational cost? Yeah,
Textile company have the higher cost, operational cost.
yeah, because in the text, if you look at the Quas, the housing apartments which you get, they have the building. Textile company also have the building. When the textile company is running its operations in the building, they pay wages to workers. Whereas here, in Quas, there's hardly any worker. You have the janitor, one or two janitors, they are taking care of almost all the apartments. So if your Quas apartments were some textile company, then all the apartments where you are living would have been the offices of the textile company or the factory. In the offices or in the factory, you have the administrators, managers, or workers who the company pay. Whereas in case of Quas, in the same blocks, the buildings, the tenants are living, students are living, and they are paying to the company. If it were a textile company, the company would have been paying. But in the housing company, for the same building, for the same maybe, and then in case of housing company, they are getting the cash. And the operational cost is less because in textile company, if you look at just visualize the size of your building, not your apartment, but the whole building of course. If it were a textile company, there would have been hundreds of people living there in one block. So people would be working next to each other and they would be getting wages from the company. But in case of Quas, you are having less number of people living, but they are giving cash to the company, not getting from it. So in that case, the operational cost of Quas is much lesser than if it were a textile company. And as I said before, that only a few people are enough to maintain its operations. If you see the janitors, there are not many. Okay, so debt capacity of Quas should be more than the textile company, given that all else being same. Any other point comes to your mind in terms of debt capacity? Mm-hmm. Something that can make you more favorite of the bank or lenders, and something which can make you not so favorite or not so attractive to the bank. What else could be the factor? Do you think risk matters? Risk factor? For example, if I say growth companies versus traditional companies. So if I say that there is General Motors versus Adobe. Who do you think? Should be more favorite in terms of risk factor? The risk factor of a traditional company like General Motors is less, whereas the risk factor of some is tech company or the growth company is more. So all else being equal, GM have relatively less risk, less operational risk in comparison to some IT company like Adobe. So that would also make an impact on the debt capacity. So all these factors are very important when it comes to the determining the debt capacity. You have chosen many companies for your previous tasks, so you can make a judgment that if this company should have low debt capacity or a higher debt capacity. So these factors, please keep in consideration when you are calculating the debt capacity. Right, and the last thing of today's discussion is about, very quickly, about the weighted average cost of capital. So yeah, the same thing I discussed here, which factors affect more profitable companies, size of the project, stage of the project. So this is something I want to discuss with you, that the weighted average cost of capital. Remember that the total capital is including debt and equity. So, for example, if the company has 60% equity. You can see here, weight of equity. WACC is weighted average cost of capital. WE is the weight of equity in the total financing or the total value of the company. RE is the cost of equity. And this cost of equity comes from where? Any theory you remember where you calculate the cost of equity? Have you studied any theory where you calculate the cost of equity? It's CAPM, Capital Asset Pricing Model. So you have weight of equity, you have cost of equity, and then you have the weight of debt. How much debt is there in the total value of the company? So the total value is D plus E, and you can calculate the weight of debt and the weight of equity. And this is the cost of debt. And how do we get the cost of debt? If you remember in the previous task, we were calculating the cost of debt by dividing the total interest you pay divided by total debt. So the interest was, you can see from the income statement, finance cost, and the total debt was your current debt plus non-current debt. And if you remember this 1 minus TC, I think you have come across. So TC is the marginal or the effective corporate tax rate. And when you combine these figures, we get the weighted average cost of capital. So if I calculate, for example, take the screenshot of this whole slide, and if I copy it, and if I go to Excel, and I just paste it somewhere here so that just to have a look. And now we have a company whose debt, can you see the, I hope you can see the spreadsheet. So whose debt is let's call it euros, is 10 million. Equity is, let's say, 17 million. And the total value of the company from the balance sheet side should be debt plus equity. So it should be debt plus equity. And we can calculate the weight of debt. So I can find out here the weight of debt should be the weight of debt and the weight of equity. The weight of debt according to the formula, is the weight of debt is equal to the debt amount divided by the value of the company, which is D plus E. So if I divide this by this, I get the proportion of debt. And if I divide the amount of equity by the total value, I get the proportion of debt and equity. Okay, if I make them in percentages, here we go. So the company is having about 37% debt and 63% equity. So we calculate weights. And then we find out that the company's the return on equity is 10%. Let's calculate here. Is 10%. Where does it come from? This 10%. Where does cost of equity come from? It comes from the theories. It can come from CAPM, or there's one more theory called APT, arbitrage. Pricing theorem. APT. But generally we use CAPM. So this 10% come from CAPM. And where does this RD come from? The cost of debt, which is here. Well, let's say that the companies pay interest payment. Let's say the interest payment of the company is, let's say, $1,019,000. The interest payments and the total debt. Well, let's call it current debt. Current debt. Well, we have total debt, so let's not split it. So we have the interest payment and we have the total debt. So let's find out the cost of debt. So the cost of debt is the interest payments you make divided by the amount of debt. So it comes to be 11.9%. No, not comment. So if I format it, it comes to be 11.9%. So we have share of debt, WD, we have share of equity, WE, we have cost of equity, RE, and we have the RD. Only thing we are missing is the corporate tax rate. And this corporate tax rate is not a headline corporate tax rate. This is the effective corporate tax rate or the marginal tax rate. So if the company's profit before tax is, let's say, 2,040,000. And the company is paying a tax of 1 million, let's say. Then we can calculate the TC. the effective corporate tax rate, which would be the tax divided by the profit before tax or the earnings before tax. So the company is basically paying 41% in terms of corporate tax rate. So we have all the inputs now, and now we are able to calculate the weighted average cost of capital. And then how do we calculate it? We just have to put these numbers in the formula. We have the share of equity times, oops, sorry. We have the share of equity why can't I find out this? So we have a share of equity multiplied by the cost of equity, and then plus we have share of debt share of debt multiplied by 1 minus corporate tax rate, and then we time it with the cost of debt. And there we go. So this comes out to be, it sounds weird, but because so many decimals, but we can change it to percentage. So our total cost of weighted average cost of capital is 8.867%. And this is because of, now you can ask me that, hey, the cost of equity is 10% and the cost of debt is 11%. So that it should be somewhere between 10 and 11. But the cost is way below this. It is because we don't include the corporate tax rate in it. The reason is that you are basically, your interest payments are tax deducted. They are tax subsidized. So essentially, even though the cost of debt seems to be 11%, but you're not paying 11%. You are basically paying 1 minus TC, 1 minus corporate tax rate times the debt. So essentially, even though your debt cost is 10.9%, but effectively you are paying 6.94% because a big portion of the debt is tax subsidized. Tax subsidized means you don't pay tax on it, because we have done so many times now that the interest payments are tax deducted. So even though the face value of debt is 11%, but effectively you are paying 6.94. So effectively 6.94 is your cost of debt and 10% is your cost of equity. So the average is about 8.86. So that's what you are paying. This is your weighted average cost of capital. Okay. So this is how we are calculating firms' weighted average cost of capital. So all the numbers, we are able to get them. Most of them, well, all of them basically, except for this CAPM thing, all of them come from the company's balance sheet or income statement. So it's fairly doable. All right. I'm not sure if I have this this calculation in the spreadsheet in the Optima, but I would save it and share it with you. But yeah. So this 6.94 is basically your this is the effective cost of debt, essentially. This is lower than the nominal cost of debt because the interest payments are tax deductible. And this we have discussed many times now, especially last week, we had a lot of discussion about it, that how the interest payments are, how you are able to pay, how the corporate tax rate is biased in favor of debt than equity. So this is what we need to know about the weighted average cost of capital. And this cost of equity is basically coming from CAPM or some other theories, but I think CAPM is the best theory. It's simpler, so it's easy to get the idea. So that's everything for today. And when we meet tomorrow, we will do one bit of the taxes. So tomorrow we will be able to complete all the issues about taxation. And that would be basically everything. And that would be the last topic of hopefully last topic of your financial management course. And then for the rest of the time, you need to do some revisions and stuff. But I would decide tomorrow if I need to include one or maybe two, some small topics in your course. But there's nothing much left now because we have covered all the more important topics. But if something is left, I would consider it again, if we need to add one or more topics. But I would say that we have done substantial amount of course already done. So, but let's meet tomorrow and continue with the remaining slides. And tomorrow we'll talk about, I will try to go a little bit in favor of Modigliani and Miller and try to not fully prove them right, but I will try to prove them almost right. But that's tomorrow. Thank you very much and have a nice day.